In the last few years, the Indian EdTech industry has become a graveyard. A nuclear winter of failed unicorns, massive layoffs, and billions in burned cash. So in the middle of this chaos, how is one company, Physics Wallah, not just surviving, but filing for a massive IPO? This is a deep dive analysis of one of the most disruptive companies in India. Physics Wallah, or PW, was founded in 2020 by Alakh Pandey and Pradeep. But its spirit began much earlier on a simple YouTube channel. It has since grown into a multi-channel behemoth, building a cult-like brand by targeting the aspirational learners in Tier 2 and Tier 3 cities. PW's first moat is its insane, disruptive pricing. A full year of Z or NEET prep can cost as little as 4,500 rupees, versus over 1.1 lakh for its offline peers. This isn't just a discount, it's a completely different market. It's the difference between the price of a few pizzas and the price of a new laptop. But this is not just another online app. This is PW's second mode, the hybrid model. It operates over 175 plus physical paths Wallah centers, blending digital scale with a local touch. They've even acquired major offline players like Xylem and decode to expand this footprint. But the real mode, the one competitors can't buy, is the community. This chart shows the scale. Over 100 million subscribers across its YouTube ecosystem. 71 million app downloads. And nearly 3.5 million paid users. This isn't a marketing list, it's a private army built on trust. This is the flywheel. PW uses its free YouTube content to build massive brand trust. This pull effect drops their customer acquisition cost to the lowest in the industry. That low cost allows them to maintain their low prices, which in turn attracts millions more to the top of the funnel. The market is highly fragmented. You have the offline giants like Alakh and Akash. You have the online heavy players like Unacademy. But PW is the only one who has truly dominated the hybrid, full stack model. And this peer comparison table shows the secret. Their marketing cost is just 10% of revenue, half, or even a third of their competitors. Now, let's get to the part you've been waiting for. The financials. The revenue growth is staggering. From 744 crores in FY23 to over 1,900 crores in FY24. They are on track to crush that again this year, posting 847 crores in just the first quarter of FY25. This is hypergrowth. But, this is the slide everyone is talking about. While revenue is exploding, look at the bottom line. A restated loss of 84 crores in FY23, exploding to a staggering 1,131 crore loss in FY24. That is a massive 5-alarm fire on the balance sheet. Or is it? This is where the real analysis begins. And this is the most important part of the video. That 1,131 crore loss is not a real cash loss. It is an illusion. The DRHP clearly states that 750 crores of that loss is a one-time, non-cash accounting charge for revaluing financial instruments, CCPS. It has nothing to do with the day-to-day business. If you remove that non-cash charge, the actual business is far healthier. The historical losses are driven by the cost of scaling, hiring thousands of new employees, from 7,200 to over 12,900, acquiring companies, and building out 175 centers. The underlying business is on a clear path to profitability. In fact, projections show a significant turnaround, with the company expecting to hit PAT break-even within the next 12 to 18 months. Why? Because those huge one-off accounting charges are gone, the expensive offline infrastructure is now built, and the paid user base just keeps growing. So if the business is healthy, why raise 3,100 crores? They are pouring fuel on the fire. This table shows where it's all going. 710 crores for marketing. 548 crores for existing leases, and 460 crores for new offline centers. This is a land grab for market share. This IPO isn't just about a company, it's about the kid in Kota or Patna who can finally afford a level playing field. And it's a test for the entire Indian EdTech sector after the Byjus nuclear winter. Can anyone be profitable and trusted? But this is not a sure bet. The risks are serious. First, regulatory. The government is actively cracking down on the coaching industry, with new guidelines on advertising, registration, and student mental health. This is a major, unpredictable risk. Second, key man risk. Physics Wallah's brand is built almost entirely on the trust and charisma of Alakh Pandey. What happens if he decides to step back? Can the brand outlive the man? This is a huge, unquantifiable risk. Third, litigation. The company is in a legal battle with competitors like Byjus and is facing tax and civil suits aggregating nearly 100 crores. While this is minor relative to their revenue, it's a significant distraction for the management. Now let's put it all together in a final SWOT analysis. The strengths are clear: that insane brand loyalty, disruptive pricing, and the 100 million strong community. The weaknesses are the volatile profits and the risk of integrating all their acquisitions. Opportunities are in scaling. And the threats are regulation and the key man risk. Now, for the investor conclusion. First, the smart money. The anchor investor list is a massive stamp of approval. PW raised nearly 3,000 crores from the biggest names in finance, the governments of Singapore and Abu Dhabi, Goldman Sachs, and every major Indian mutual fund. But what about the price? At 100 rupees per share, the IPO is valued at an eye-watering 108 times estimated FY25 earnings. This brings us to the bull versus the bear case. The bull case is that revenue continues to grow at 30% plus, EBITDA margins expand to 18% or more, and the company successfully scales into new categories. The bear case is a policy shock from SEBI, failed M&A integration, or a massive sell-off when the anchor investor lock-in period expires. So, here is the final verdict. This is not an EdTech IPO. It's a trust IPO. You are not betting on an app, you are betting on Alakh Pandey's brand and the idea that community is a stronger moat than any tech platform. The 1,131 crore loss is an accounting illusion. The real risk is the sky-high 108 XP/E valuation. This is a high-risk, high-growth play, only for investors with a long-term horizon.